Welcome to the deep dive. You know, in a world that's buzzing, really buzzing, with talk about renewables, it's still so important to understand traditional energy investments.
Absolutely. Especially those offering high yields. They can be key for a balanced portfolio.
Right, because it's easy to forget how much we still rely on oil and natural gas day to day. I mean, meeting global demand is just fundamental.
That really is. These sources are still central.
So today we're diving into an article from The Motley Fool, Top 3 High-Yield Energy Stocks for 2025, written by Ruben Greg Brewer. We're going to explore the three companies he highlights as, let's say, compelling options for the year ahead.
And that term high yield is really key here. We need to understand why it matters so much in this sector.
Okay.
We're looking for stocks with significant dividends.
Yeah.
Right. And that can be a big plus in a sector known for, well, its ups and downs. Getting a handle on these different plays is pretty crucial if you want to understand the energy sector quickly, but also thoroughly.
Okay, let's unpack this then. First up, Chevron, CVX. The article mentions investors faced some material uncertainty over the past year or so.
That's right.
But apparently those negatives, the main ones anyway, seem to be sorted out now.
Yeah, for the time being. We're talking about the Hess merger, which was a bit challenging for a while.
Right. And the Venezuela investment, that seemed complicated.
Oh, yeah, that had become a real political football, as the article puts it, just tossed around. But that situation seems resolved too, which removes a layer of uncertainty.
So what makes Chevron attractive now, despite that recent noise?
What's fascinating is its core strength. It's an integrated company,
Keening.
meaning it does everything, finding the oil and gas, refining it, selling it. That model makes it pretty resilient when energy prices swing wildly.
Okay, that makes sense. Built-in shock absorbers, sort of?
Exactly. And underpinning that is a really rock-solid balance sheet.
Right.
Very strong financially.
And the dividend track record is pretty eye-opening.
It really is. They've increased the dividend annually for 38 straight years. That's quite a statement.
38 years, wow.
It shows a real commitment to returning cash to shareholders consistently through all sorts of market conditions. Think of it as a defensive quality.
And the yield itself?
It's good, 4.5%. That's noticeably higher than the average energy stock, which sits around 3.4%. And, it's a giant $313 billion market cap.
That kind of consistency is impressive. But does a long streak like that ever suggest maybe they're not growing as aggressively?
Okay.
Or is it purely strength?
I'd say it's primarily a sign of strength and stability. They do pursue growth, but their financial approach prioritizes reliable returns. It appeals to investors looking for that dependability, that income stream.
Got it. So Chevron is about that integrated stability. Now the next one, Enterprise Products Partners, EPD. This sounds like a totally different kind of play.
It is, yeah. A really interesting contrast.
Especially for yield. The article mentions a lofty 7% yield, and it's a master limited partnership, an MLP.
Right. And that high number, 7%, often makes people ask.
Does that mean high risk?
Exactly. That's the immediate question. But the article stresses that for Enterprise, that's not the case.
Why not?
Well, look at the numbers. They've increased their distribution. That's the MLP equivalent of a dividend for 26 years straight.
Okay, another long streak.
Yep. They have an investment-grade balance sheet, which is a strong rating. And crucially, their distributable cash flow covers the payout 1.7 times over.
1.7x coverage. That sounds
Comfortable?
very comfortable. In this space, anything over 1.2x is generally seen as healthy, so 1.7x gives them a lot of cushion. It speaks volumes about their financial health. So how does their business model generate that kind of stability?
Okay, so Enterprise is in the midstream part of the energy sector.
Midstream, meaning pipelines,
Yeah.
storage.
Think of them like toll collectors on the energy highway. They own essential infrastructure pipelines, storage tanks, processing facilities.
Yeah.
They make money by charging fees for companies to use those assets. Simple as that, really. It generates very reliable cash flow.
Because the energy needs to move regardless of the price.
Precisely. Whether oil is $50 or $100 a barrel, it still needs to get from A to B. So enterprise investors mostly sidestep that direct commodity price risk you get with producers like Chevron.
That's a really key difference.
It is. One important thing for U.S. investors to remember, though, because it's an MLP, you get a K-1 tax form, not the usual 1099 for dividends. It's just something different to be aware of, maybe chat with a tax advisor about.
Good practical point. And their size.
Market cap is around $68 billion. So still substantial, but smaller than Chevron.
Okay, that fee-based model versus commodity exposure is a crucial distinction. It definitely changes how you might think about investing in energy.
Yeah.
Right, on to number 3, TotalEnergies, TTE, another big integrated player.
Yes, another giant. Similar to Chevron in that integrated model, but with some key differences noted in the article.
Like what?
Well, compared to Chevron, and actually typical for its European peers, TotalEnergies tends to use a bit more leverage.
More debt.
Yeah, they borrow more, but they also tend to hold more cash on the balance sheet at the same time.
Hmm, interesting balance.
It gives them flexibility, perhaps, but it means managing that debt is crucial. The article describes Chevron's low-debt approach as lower risk, generally speaking.
But TotalEnergies is still considered strong.
Oh, absolutely. It's seen as a very strong, well-positioned, integrated company, just with a slightly different financial structure.
And it also has a high yield.
A huge yield, actually, 6.5%. But there's a catch for U.S. investors.
Okay. What's the catch?
French taxes. Since it's a French company, you'll have French taxes withheld from the dividend payment.
Can you get that back?
Some of it, yes, through U.S. tax filings, but usually not all of it. It just eats into the effective yield a bit.
Something to factor in.
Definitely. But connecting this to the bigger picture, TotalEnergies has a really interesting positive going for it, something unique among its peers, according to the article. Which is, it's apparently the most aggressive in investing in electricity and clean energy.
So they're looking ahead.
Very much so. The article calls it a smart hedge. They're essentially using the cash generated from their traditional oil and gas business to fund their transition towards cleaner energy sources.
So using today's profits to build tomorrow's business.
That's the idea. It addresses head-on what's probably the biggest long-term risk for the whole sector, the shift away from fossil fuels. Now, this aggressive pivot isn't without challenges, right? Balancing the old business with investing heavily in potentially lower return, early-stage clean energy projects takes careful management. It's a calculated risk, but with a clear long-term vision.
That is a fascinating strategy. So Chevron for stability, Enterprise for fee-based income. TotalEnergies seems like a bet on a transitioning future.
You could put it that way. Their market cap is around $133 billion, placing them between Chevron and Enterprise in size.
So pulling these three together, what does this variety tell you, the listener?
Well, it shows that different energy choices suit different investors, right?
Makes sense.
To quickly summarize the article's take, Chevron looks like a solid pick for long-term investors who want that direct commodity exposure, but value that incredible dividend consistency.
Okay.
Enterprise Products Partners is presented as a great option if you specifically want to avoid that direct commodity price risk, focusing instead on the steady income from its midstream fee-based model.
Right, the infrastructure play.
Exactly. And then TotalEnergies emerges as maybe the high-yield choice if you believe clean energy is a real opportunity, even for an oil major, and you're comfortable with its financial approach and the international tax details.
It really underscores that there isn't just one right way to invest in energy, is there? Especially if you're targeting high yield. Understanding these different models seems crucial.
Absolutely. Each caters to different priorities, different views on risk, and different outlooks for the energy transition.
So thinking about what the author Ruben Gregg Brewer said about dividends being a window into a company's soul,
Yeah, that's an interesting quote.
it makes you wonder, what do those decades-long dividend streaks from Chevron 38 years and Enterprise 26 years really tell us about their core resilience and how they adapt?
It's a great question. Does it show deep stability and ability to weather any storm?
And then what does that imply for TotalEnergies? Is their big push into clean energy, funded by oil, a sign of proactive adaptation for the long haul? Or is it perhaps a more speculative leap into a less certain future compared to the others?
That's the multi-billion-dollar question, isn't it? A really provocative thought to chew on.
Definitely something to consider. We hope exploring these different angles helps you as you continue your own learning journey in energy investing.